Hello, my name is Kerry Gur from the University of KwaZulu-Natal. I work within the School of Accounting, Economics and Finance in the discipline of accounting. Today we will discuss Chapter 2, whereby we look at the conceptual framework. You will find that the conceptual framework, while it is not an accounting standard in its own right, it is a framework upon which all of the accounting standards are based, and thus makes it a vital part of your learning. With the conceptual framework, we need to understand where this fits in our entire concept of financial statements. So firstly, we need to understand what is our objective of general purpose financial reporting. Ultimately, it is to provide useful information to the users of those financial statements. The importance being there that we need to provide useful information. This is where the conceptual framework then comes in. It will aid us in achieving this usefulness objective and provide a basis upon which the accounting standards are built. You can think of the conceptual framework as the alphabet. We then use the alphabet to create words, i.e. the accounting standards. We then move on to the International Financial Reporting Standards, which are the foundation on which our financial reports are generated, and thereafter we are able to generate our financial reports. So as we can see at the bottom, the aim is to achieve the objective by applying the EFFSCs based on the concepts in the conceptual framework. Here we can see where the usefulness is provided through using the conceptual framework and ultimately the accounting standards. Like we said, IFRS, a conceptual framework is not an IFRS itself. It is not an accounting standard. However, it is a framework upon which the accounting standards are based. It does not override any specific accounting standard, but should work in harmony with them. The purpose of the conceptual framework is to assist the International Accounting Standards Board to develop the accounting standards themselves, as well as to assist the people who are preparing the financial statements to create the accounting policies. They can use the conceptual framework to aid them in their decision-making on which policy to apply. It assists all parties with that understandability characteristic and interpret our international financial reporting standards. You'll find the conceptual framework in fact has 8 full chapters. We will concentrate on the first 7 for the purposes of Accounting 211. Chapter 8 you will learn about in 3rd year. We'll then start off with the very first chapter of the conceptual framework, which is looking at the objectives of general purpose financial reporting. We already touched on this briefly, and we said that overarching objective is to provide information that is useful in making decisions about providing resources to the entity. When looking at this, we need to understand who are the people we are preparing these financial statements for. In fact, in terms of the objective, there are 3 primary users that we use to assist in developing our financial statements. When preparing these, we must do so from the perspective of knowing the 3 primary users of investors, lenders, and other creditors. From your first year knowledge, you will know that there are other users of financials, such as customers, the government, SARS, employees. These people are all also users of the financials. However, they will not be the key users upon which we are concentrating when developing the financial statements. What information do we need to provide when preparing our financial statements? Firstly, it is the economic resources, i.e. the assets, and the claims against those resources, i.e. equity and liabilities. Think of the format of the statement of financial position. You have the assets at the top, and the bottom half has the equity and liabilities, the claims on the resources. The changes in economic resources and claims focuses on the statement of profit or loss and other comprehensive income. Please ensure when you are writing out this title in a test or exam, you write statement of profit or loss, not and. You cannot have a profit as well as a loss. There are limitations to general purpose financial reporting. Firstly, it focuses on the economic side of things. So we are not looking here at a fully integrated report, including both the social and the environmental aspects, as well as the narrations that provided by an auditor's report and a director's report. It is not designed for all users. We are only focusing on those three primary users of investors, lenders, and other creditors. It is also not designed for all types of decision and is based on historic type information. Historic information, it means to us that this information is simply a record of what has happened in the past financial year. It is not designed to show the entity's value. If you do require to know what a company's value is, you will learn more about this in managerial accounting and finance in the second semester. General purpose financial reporting. Users make decisions based on their potential returns. When we think about our users, we said there are three of them. The first being investors. What type of potential returns would an investor expect to receive? Firstly, they would get dividends by owning shares, as well as they would want to have capital appreciation. What do we mean by capital appreciation here? It means if we are investing in a company and we purchase a share at 10 Rand, we would hope that this share would increase in value to say 20 Rand or 30 Rand and then sell them at a profit. A user's potential returns is based on the assessment of two main aspects. Firstly, the prospects of making the future cash inflows. Like we said, for investors, there are two streams of potential inflows through dividends and capital appreciation. For your lenders or your other creditors, they would hope to receive some form of interest as a result of providing this loan to the company. They would also want to look at management's efficiency as well as their effectiveness. This would come into play in terms of your financial ratios. When looking at your financial ratios, you might want to consider the return on assets. Is the company using these assets efficiently in terms of the revenue that is generated, or do they have these dead assets lying around that should in fact be disposed of? For users to make this assessment, they need financial reports to contain various information from all these aspects. So firstly, the economic resources being the assets, the claims, the liabilities as well as the equity, and then changes in these resources and claims being your incomes and expenditure. You then will be able to use this information to determine various financial ratios and analyze the management's efficiency and effectiveness. Going back to first year, you would have learned about the generic accounting equation of A equals O plus L. Our economic resources and claims really gives life to this accounting equation in the statement of financial position. The changes in economic resources and claims includes the statement of profit or loss and other comprehensive income, which is based on the accrual system, whereas the statement of cash flows is based on a cash system. You'll find that your statement of cash flows is the only financial statement item that is based on the cash system. When understanding the statement of cash flows, we would want to note what is the difference between an accrual system and this cash system. The cash flow statement will remove all of those key judgments, estimations, and assumptions made by management, because here you will remove the effect of items such as depreciation, amortization, as well as bad debts. It will show the whole cold hard cash that the business has for that particular financial year. You will sometimes find companies who have gone bankrupt or into liquidation may have a very big and beautiful profit on the statement of profit or loss, whereas the statement of cash flow may show they are bleeding cash. Where they are in a cash negative position, which is worsening year upon year, that may give you an indication of trouble. The statement of change in equity will provide information on the equity itself and where these changes have taken place, what events has happened within the business itself. The key here is to review why resources or claims have changed. This will help you in your decision-making process to understand what has taken place within the entity. For example, if inventory has changed from 1 million rand in the prior year to 2 million rand in the current year, you may wonder, why are they stock keeping their inventory? Is some of this inventory included in the 2 million rand obsolete or no longer in a sellable condition? This will all be information that you can generate from understanding the movements between various balances. Our qualitative characteristics, we firstly want to understand, why do we have qualitative characteristics in the first place? Well, they are going to aid us in our overarching objective of achieving usefulness in our financial statements. Your qualitative characteristics are further broken down into two main categories: the fundamental characteristics and thereafter the enhancing characteristics. You'll find within your tutorials that it is important to understand there is sometimes a payoff between your qualitative characteristics. You may have an instance where satisfying a fundamental and an enhancing characteristic may be in conflict. Where these are in conflict, which do you think you must satisfy and which do you think you would leave out? It must be the fundamental characteristics. Those are there to be satisfied first and foremost, and enhancing is there if the fundamental are firstly satisfied. Our fundamental characteristics are further broken down into relevance as well as faithful representation. Understanding what does relevance mean? There has been a lot of talk around relevance, and particular with company financial statements, there has been a big drive towards reducing the page numbers in the financial statements. It is found that many companies had provided very cumbersome financial statements of 200 plus pages. This often did not aid the users of those financial statements, as they were unable to determine what was the important or useful information over 200 pages. It became important to really break down what is relevant and that this type of information is provided to the users to make useful information more poignant. Okay, so more important. It is shown at a very more prominent space as opposed to the rest of the information. Understanding relevance, there should be predictive type information whereby we should be able to ascertain some type of trend, and we could then predict some sort of value going forward in the future. Whereas confirmatory information means we've made a prediction in a prior year, and this information can now either confirm or reject our prediction made previously. We then have materiality, which is a very important concept within accounts. Materiality, simply by definition, is if the decisions of users about a specific reporting entity could be influenced if it were misstated or omitted from the financial statements. So that means information is material if it would change the decisions of the users should it be left out or misstated. Faithful representation also carries three subheadings. Firstly, it must be complete. For our financial statements to be complete, it means nothing must be left out. You don't want a loan to be hidden and not included within your liability section. They must be neutral, so they must be free from bias. When these key estimates, assumptions, and judgments are made, they must be made from a point of being neutral and must not be manipulated in any sense. They should also be free from error. We do not want to have any material misstatements when it comes to the figures in the financial statements. Our enhancing characteristics are further broken down into 4 items. The first one being comparability. Remember, comparability needs to be from 2 perspectives. Firstly, you should be able to compare your financial statements from the prior year to the current year. And you must also be able to compare financial statements between various entities. particularly if they are operating within the same economic environment. So supermarkets, for example, you would want to compare Pick n Pay with Checkers, with Spar, etc. Comparability is important, especially when it comes to your required. You could be in a test or exam asked to provide comparatives. Where comparatives are required, it means you must provide us a solution showing both the prior year values as well as the current year values. If comparatives are not required in a test or exam, that means we must provide the current year information only. Verifiability, direct or indirect. This means there should be some sort of source document for each value that is provided in the financial statements. Also, if an accountant were to follow the same audit procedure, they should reach the same audit conclusion. Timeliness. This means that the financial statements must be available in a timely manner. It is important to understand that as time goes on, information becomes less relevant. With it being less relevant, it then does not become useful in making decisions for the entity. The last one for your enhancing characteristics is understandability. When we talk about understandability, we are referring to people having some form of financial knowledge of the accounting standards. They then know the basic language for the financial statements and therefore are able to review and analyze the information contained therein. The third chapter is looking at financial statements and the reporting entity. Your financial reports have more information than your financial statements and are descriptive in nature. So you'll find your financial report will have the financial statements being the economic information, as well as management efficiency and effectiveness. This will be included in items such as your social, environmental, director's report, etc., that are narrative in value. Financial statement, this is maintaining only the economic phenomena and looking at the financial statements and number crunching only. Our set of financial statements is broadly categorized into our statement of financial position, our statement of profit or loss and other comprehensive income. Our other statements also include the statements of cash flows, the statement of changes in equity, as well as the notes. Remember, the notes to the financial statements will include more detailed information and are an important and vital part of the financials. When required to provide some form of disclosure in an assessment, you could be asked for any or all of these various elements. A reporting entity is defined as an entity that is required or chooses to prepare financial statements. They may be required, such as if they are a JSE listed company, or they may choose to. Perhaps they are looking for some investment or they might be looking for some form of loan from a bank. The reporting period is normally for a period of 12 months or 1 year. Something to note at this point, but will be expanded upon in second semester, is events after the reporting period. These are events that take place after the financial year end, but may give you information of an item or some type of event that is relevant to what took place in your financial year. An example may be if you are a manufacturer of soap. After year end, one of your customers may have had an allergic reaction to the new soap that you have produced, and in this court case, it was found that your soap was in fact toxic. This may arise where you now need to pay out the customer some form of settlement, and if you think of your financial statements, the soap sitting in your inventory is toxic in nature and you are no longer able to sell it. This item sitting in your financials at year end is in fact tainted in nature and needs to be written down to a nil value. You may also need to provide a provision for money that would need to be paid out to other customers that may come forward. The prior reporting periods should also be included on each set of financial statements, as they are important for that enhancing characteristic of comparability. Looking at the going concern, This is the underlying assumption upon which every set of financials are prepared. What this means is that the entity will continue operating for the foreseeable future or for at least the very next financial year. This also further means that they do not intend or do not need to liquidate or materially downsize their operations. If they do need to either liquidate or downsize their operations, they must disclose this type of information. What event led to this company not continuing in the foreseeable future? And upon what basis have the financial statements been prepared? Have they been on the going concern basis or rather the liquidation basis? There are various elements to the financial statements which you have a learned knowledge of from accounts in first year. The 5 elements are related to 2 specific financial statements. The statement of financial position holds assets, liabilities, and equity, whereas the statement of profit or loss and other comprehensive income holds the income and expenses of the entity for the year. We'll firstly look at the asset definition. This is in terms of the new conceptual framework and needs to be applied in your test or exams, particularly when the required states you must discuss in terms of the conceptual framework. Then you would be expected to apply these new definitions. The asset definition is a present economic resource. The term economic resource is further broken down into the fact that the company has some sort of rights, and as a result of this right, they have the potential to produce economic benefits. This asset is controlled by the entity. How do we define control? It means that the entity has the ability to direct the use of the economic resource, and they also have the exclusive right to its benefits or to enforce their legal rights, resulting from past events. Past events is typically the application side, which students normally get correct. We're going to now look at example 1 and 2 from your Gripping GARP textbook. Example 1 states that Alpha rents office space from a landlord at 10,000 Rand per month. It uses the space to run a business selling financial advice. At 31st December 20x4, it pays for the rent for January 20x5. You are required to, from Alpha's perspective, prove that this payment is an asset at 31st December 20x4. Firstly, let's understand the scenario. We are now in December 20x4, but we are paying our rental expense for the next month, January 20x5. Here we have a prepaid expense, which we know from our previous knowledge is an asset. We now want to apply the definition of an asset to ensure that this prepaid expense still falls under the new conceptual framework. To apply the definition of an asset, it is a present economic resource. What is the right that the company has? They have the right to occupy the space for the following month, January 20x5. They can then use this office space as they see fit. They can use the office space as well to produce cash. How so? If it is an admin building, they can use this space to continue their operations, to maintain customers. They could use it as a warehouse if they wish to do so, to dispatch inventory to the various consumers. This will all generate revenue for the entity. The resource controlled by the entity, they certainly have the ability to direct the use of the office space. The entity can choose how to use the office space themselves and therefore obtain the economic benefits derived by the usage of that space. They can also prevent anybody else from occupying that office space, as they have the sole legal right to occupy that space already paid for. As a result of a past event, signing of the rental agreement with the landlord, as well as the prepayment of the 1 month's rent for January 20x5. Our second example states that the accountant is concerned that the new asset definition in the conceptual framework will result in certain items which are currently considered to be assets as no longer meeting the definition, and vice versa. You're required to firstly discuss whether the accountant's concerns are valid, and then secondly, to prove that the following are assets, namely inventory, trade receivables, bank, land, equipment, investment in shares, as well as investment property. We will go through each of these items. Firstly, do you think that the accountant's concerns are valid? You'll find that the new definition of an asset is much more inclusive in nature. Very often, any items that were defined as an asset under the old definition remain an asset under the new definition. It simply provides for more items to be included as an asset. We'll firstly look at inventory. Inventory, in terms of the definition of an asset, is it a present economic resource? Well, what right does the entity have? They have the right to sell this inventory that they have either manufactured or purchased. By selling this inventory, will they generate an inflow of economic benefits? Yes, they will. They will either receive cash from the customer who is purchasing the inventory, or alternatively, if they are purchasing on credit, we will have a trade receivable or debtor in our books. How is the inventory controlled? It is in fact controlled through legal ownership, which is supplemented by the source document of an invoice. That invoice will be a cold hard proof that we in fact own the inventory. The past event is both the purchasing of the inventory and obtaining control. We will learn more about control as we go through PPE as well as inventory, where there are various shipping requirements, and these result in risks and rewards transferring on various bases. Trade receivables. How do these apply in terms of the asset definition? So firstly, a present economic resource. What right does the company have in terms of trade receivables? Well, they have the right to collect the amount that is owed to them. How will this generate future economic benefits? It will result in an inflow of benefits from the cash that is received upon collection of that money that is owed. How is trade receivables controlled? It is controlled through the legal contract of sale. That receipt and engagement in the sales transaction will provide the legal standing to reflect the money that is in fact owed. And the past event is completing the performance obligations. Think to revenue, whereby revenue, the fourth step is actually performing the performance obligations. This will ensure that the revenue is in fact earned and can then be recognized. Looking at bank, this is in terms of a positive bank balance, so not an overdraft. How does this satisfy the asset definition? So is it a present economic resource? Yes, we have the right to receive the cash from the bank. That cash that is deposited in that particular bank account will be the company's itself, either through their own deposits or payments received from the customers. The usage of the cash has the potential to generate economic benefits. The cash in the bank can either be used as a form of investment to earn interest, or alternatively as working capital throughout the business to ensure we generate future revenue. How is the bank asset controlled? It will be controlled through a legal contract with the bank. Upon opening the bank account, there will be terms and conditions that you will sign and agree to with the bank. And the past event will be the contract with the bank, as well as the depositing of the cash either by yourself or from customers. Looking at land, how do we apply land as an asset under the new conceptual framework? Has a present economic resource. So what right does the company have? Well, they have the right to direct the use of the land as they see fit. They could choose to build a building on the land or use it as a parking lot or a warehouse. The usage of the land has the potential to generate future economic benefits or resources. Yes, how they choose to use the land will ensure that they will somehow generate economic resources. Should they choose to use the land as a parking lot, that would mean they can attract more customers to come through their doors, and they could then generate additional revenue. Controlled through legal ownership. This would be through a title deed for land in particular. It is important that we know our source documents and have the correct terminology for each various asset. The past event would be the purchasing and obtaining control of the land, which we will elaborate more on as we go through the concept of control in property, plant, and equipment, as well as inventory. Looking at equipment, how is equipment defined as an asset under the new conceptual framework? Is it a present economic resource? Yes, the company does in fact have the right to direct the use of the equipment. They can choose how they want to use it. It could in fact be a vehicle which they may choose to use for deliveries, or alternatively as an administrative vehicle or an employee vehicle. They have the potential to generate inflow of economic resources or enhance other economic resources. It is important at this stage that we understand an inflow of economic resources does not simply just mean that I will be receiving cash or receiving revenue. They could in fact be enhancing another asset to make the asset run faster or use less electricity or less water. Controlled through legal ownership, this would be reflected through the invoice itself, and the past event is purchasing and obtaining control of the equipment. Investments in shares, when we look at the definition of an asset as a present economic resource, we need to know from the question, what is the intention of the entity itself? Do they intend on holding this investment in shares, or do they intend on selling the shares in the future? The intention will help drive what type of inflow you are expecting to receive. Should an entity wish to hold their shares, that then means they would hope to expect dividend flow in the future. If they choose to sell their shares, they are hoping to receive an inflow of benefits through the capital appreciation or increase in value of those shares over time. They're controlled through legal ownership, namely a share certificate itself, and the past event is the purchasing and obtaining control of the shares. Finally, we have investment property to discuss under the Asset Conceptual Framework definition. The present economic resource, what right do we have in terms of the investment property? We have right to direct the use of the property, and in particular for investment property, they could have two intentions. It could either be to lease out the property to a tenant, or alternatively, capital appreciation, i.e., we want the building, the investment property, to increase in value with the intention of selling it at a higher price than that which we bought it. The inflow of cash would either be from the lease rental income that is received if we choose to rent out the property, or alternatively, if capital appreciation is the intention, we will receive an inflow of benefits when that property is sold at the higher value. It is controlled through legal ownership. Being a property, the correct legal ownership document would be a title deed. And then finally, the past event would be the purchasing and the transfer of that property into the company name. This is hard work. I already had a double today, so I'm surprised if I have a voice by tonight. How long do people normally book sessions for? An hour. Okay. How long was that one, the 25 page? Do you know? Okay. We're sort of there. I just start talking. Hello, my name is Kerry Gur from the University of KwaZulu-Natal. I work in the School of Accounting, Economic and Finance under the discipline of accounting. We will continue on with our conceptual framework lecture, looking now from the liability definition. What is the liability definition under the new conceptual framework? It is a present obligation. What is important at this stage is we understand it is not a future commitment. It is a present obligation today. What that means is that if the company were to close down today, would they still be obligated to pay this value? When we look at the breakdown of a present obligation, it is a duty that the entity has no practical ability to avoid. Okay, so there's no getting out of it. This obligation is there, and it is not something that they would be able to remove from their financials. To transfer an economic resource, the economic resource typically in these types of scenarios is cash, resulting from past events. We're now going to look at example 3 and 4 from your Grip and Garb textbook. Example 3 says, Beta rents office space from a landlord at 10,000 Rand per month. It uses this space to run a business selling financial advice. At 31st of December 20x4, it still owes the rent for December 20x4. You're required to discuss from Beta's perspective and prove that this payable is a liability at 31st of December 20x4. Let's understand the scenario. Here we have an amount of 10,000 Rand that is owed at the financial year end. We then know that the journal entry would be debit rental expense and credit accrued expense. Accrued expense is going to be our focus for this example. As we know from our previous knowledge, an accrued expense is a form of liability. Let's apply this to the new conceptual framework liability definition. The definition states that it is a present obligation. As we know, there is a duty to pay the landlord the rental for December 20x4. We have already made use of this service and occupied this space for December, and thus we are required to pay for this service. There's no practical ability of avoiding this monthly rental payment, as it is legally enforceable rental agreement. Okay, if the business were to close down at the end of December 20x4, they would still be liable for this rental for 20x4. There's no ability to avoid this payment. The transfer of economic resource, it will be an outflow of cash when the payment is made to the landlord, and the past event was the usage of that office space for the period of December 20x4. Looking at example 4, the accountant is concerned that the new liability definition in the conceptual framework will result in certain items which are currently considered to be liabilities to no longer meet the definition of a liability and vice versa. You're required to prove that the following are in fact liabilities under the new conceptual framework definition: trade payables, provision for legal costs, where you are taking a competitor to court over patent infringement, and a bank overdraft. Firstly, looking at a trade payable. This would be a creditor to the business. So the business has purchased something on credit from a supplier and would give rise to this trade payable. Is it a present obligation? Yes, there is in fact a duty to pay the supplier. And can you avoid paying the supplier? Certainly not. You would have already entered into some form of contract with purchase with the supplier. You may have already taken control of the equipment or the inventory that you have purchased from them. And if you were to close down the business today, you would still be liable for that payment to the supplier. The transfer of economic resource, that will be the outflow of cash when you pay the money over to your trade payable creditor or supplier. And as a result of a past event, that would give rise from the purchase and obtaining possession of the goods. Looking at the provision for legal costs, do we have a duty to pay the lawyer who has assisted us with this litigation? Yes, we have a duty to pay them. We have made use of their services, and we simply cannot avoid making that payment to the lawyer. If we were to close down today, could we avoid paying the lawyer? No, there is a legal contract or a service level agreement that has been entered into with the lawyer, and you cannot avoid the payment of that value. Transfer of economic resource. There will be an outflow of cash when the payment is made to the lawyer for the legal costs. As a result of a past event, this would be the engagement of the services of the lawyer that has already been used, and therefore you would be liable to pay for the service that has in fact been provided. A bank overdraft. This is a bank account that is in fact in a negative balance, so it does mean that the entity owes the bank money. Is there a present obligation? Yes, there is a duty to pay back the bank this value that is an overdraft. Is there an ability to avoid payment? No, you cannot avoid paying back your overdraft due to the legal nature of the credit granted. There would be some form of agreement between yourself and the bank granting you this credit overdraft facility, and even if you close down the business, you would still be liable to pay the bank back that money. The transfer of economic resource, this would be in the form of an outflow of cash when you are now satisfying the overdraft facility as a result of a past event, and the past event would be the usage of the overdraft facility itself. We now move on to the equity definition. The equity definition is defined as the residual interest in the entity's assets after deducting all its liabilities. I draw your attention back to the basic accounting equation of A equals O plus L. If you were to rearrange this and make O, i.e. equity, the principal matter of the equation, you would find that O equals A minus L. This feeds back to the definition where they say that equity is in fact the residual interest after deducting the liabilities from the assets. When looking at the income definition in more detail, it states that it's an increase in assets or a decrease in liabilities, resulting in increases in equity, other than contributions from holders of equity claims. To break down this definition at this point, we need to understand that contributions from holders of equity claims, that really is a contribution of equity into the business. So from one of the owners, they are now contributing towards the business as a form of equity. Okay, that is then excluded from the definition of income. We now look at example 4 from your Gripping GARP textbook. If an entity receives 100 Rand in cash, here we can see an increase in the assets, but there is no increase in liability. Therefore, there must be an increase in equity. Think about your accounting equation. A equals O plus L. If A on the one side is increasing, on the other side you have O plus L. If there is no increase in your liabilities, then certainly equity has to increase to keep the equation equal to both sides. An increase in equity can result from either a contribution from holder of equity claim, i.e. a contribution to the business from the owner. It could also be an increase in income or a decrease in expense. How does that take place? Think about equity. You do have within equity the notion and account of retained earnings. Retained earnings, if that is to increase in terms of the profits, so increase in income would increase our profits, would increase our retained earnings, and ultimately increase equity. The contra is true for an expense. If we have a decrease in expense, then we will have an increase in profits, an increase in retained earnings, and thereafter an increase in equity. So it's important to understand the mechanics of how an income and expense ultimately affects retained earnings, which has a knock-on effect on the equity. The expense definition is a decrease in assets or an increase in liabilities resulting in decreases in equity other than distributions to holders of equity claims. Now, what would be a distribution to holder of equity claims? This would be a distribution to the owners of the company. Who are the owners of a company? Those would be our shareholders. So what would be a kind of distribution to a shareholder? That would be a form of dividend. So as we can see, a dividend is excluded within the definition of an expense as a result of the final bullet point. We are now going to look at example 5. Example 5 states that Beta rents office space from a landlord at 10,000 Rand per month. It uses the space to run a business selling financial advice. At 31st of December 20x4, it still owes the rent for December 20x4. Now you will notice that this scenario is very similar to the one that we provided for liabilities. In liabilities, we said that we would debit the rental expense and credit the accrued expense. Here, when focusing on the expense definition, we will focus on the debit of the rental expense. We are required to prove that Beta's payable results in an expense at the end of December 20x4. The increase in liabilities. Here you can refer to example 3 that we did in the previous session. This will show you that we had an increase in the accrued expenses. Where we now found that we have an increase in liabilities, it results in a decrease in equity. Here's the accounting equation to understand why. Firstly, our first bullet point and example 3 notes to us that we had an increase in liabilities. If we are crediting an accrued expense, we are certainly increasing a liability. There was no change in the asset. So when looking at our accounting equation, assets equals liability plus equity. So if there's no change in assets, but liabilities have increased, it therefore means that equity must have decreased to keep our accounting equation equal on both sides. Is the decrease in equity a distribution to an owner of the company? So is the decrease in equity a dividend? No, it is not. It is a payment of rental expense. It certainly has nothing to do with the payment of the owner of the company. In fact, it is a payment to the landlord, not an equity participant. If we look at the journal entry, we expect our expenses to increase, debit rental expense, and credit our rent payable being a liability. Chapter 5 of the Conceptual Framework discusses recognition and derecognition of the accounts within the financial statements. If we are to recognize something, that means that we must journalize it. So we must provide a journal entry to show that we are in fact recognizing that particular item. If something is not recognized, perhaps it falls short of one of the definitions, but if it's still relevant, we need to focus back to our fundamental characteristics, and this may require disclosure of the information in the notes. This does not mean you're going to have a figure for it and you're not going to have a journal entry for it, but you may have some sort of written item in your notes to provide information because this is deemed relevant to the users of the financial statements. You must assess the cost and benefit of going through a recognition or derecognition. Sometimes it can be very costly to determine certain figures in requirements of the standards. An element can only be recognized if it meets both the definition as well as the recognition criteria. It cannot meet one and not the other and be recognized. Both must be satisfied for recognition to take place. Now that we know we must look at the recognition criteria in conjunction with the definitions, we are now going to expand upon our knowledge of recognition criteria. Assets and liabilities and any resulting income, expenses, or changes in equity must only be recognized if the user would find this information useful. So always pulling ourselves back to that objective of the financial statements and the usefulness of the information. If information is relevant, we need to consider the various uncertainties that may affect this particular assertion. So relevant, what do we want to consider in terms of the recognition criteria? We want to look at the existence uncertainty and the outcome uncertainty. And we'll expand on these on the next slide. We also need to consider, in terms of usefulness, our other fundamental characteristic of faithful representation. Faithful representation may be affected by measurement uncertainty. Now, looking at the uncertainties in more detail, firstly, to understand the existence uncertainty, we're not sure if a particular item will exist. Well, what do we mean by that? There may in fact be a legal dispute, and we are not yet certain whether an obligation perhaps exists or not. When looking at outcome uncertainties, we want to look at the probability. The probability might affect, as you've seen, our previous recognition criteria, which were that there was a probability of future economic benefits, and there was also reliability in terms of the cost or value of that particular item. These two old recognition criteria are housed within the outcome uncertainties in terms of probability and the measurement uncertainties in terms of the cost or value being reliably measured. When looking at the outcome uncertainty in more detail under the new conceptual framework, we're looking at the probability of the flow of economic benefits, which may possibly be remote or low. The timing or amount in relation to the flow of economic benefits may be uncertain. So these are the outcome uncertainties that you would be expected to discuss in a test or exam. When looking at the measurement uncertainty, here we are trying to ascertain the value of the item that we are recognizing. Measurement uncertainty arises when the amounts presented in the financials can't be observed directly and has some form of estimation. The level of uncertainty must be considered to be acceptable. Okay, so are they highly reliable estimates? That would tell us that there is low measurement uncertainty and therefore we could recognize that particular item. The accounting mismatch concept. If information is not recognized, it may cause a recognition inconsistency. Where this happens, the accounting standards have stated that the accountant must provide for explanatory information in the notes to explain the uncertainties as well as the mismatch. Okay, so it's all overarching, providing the objective of useful information and making sure that the information provided is relevant, even if it is not recognized. Looking at derecognition, it's easy to recognize something, but how do we know when to derecognize something from our financial statements? Well, this will occur when your asset, your liability, etc. fails to meet the relevant definition or recognition criteria, and therefore you would know you're at a point where you must derecognize this asset or liability from your financial statements. This could be a removal of an entire asset or liability or only part thereof. So it is dependent on the scenario as to how much of that asset or liability will be removed from the statement of financial position. Chapter 6 is looking at measurement. Measurement is really split up into two main sections as we go through our accounting standards. You will see we will discuss first the initial measurements, which means the amount at which an item is measured initially in their very, very first time we are recognizing them in the financial statements. There's also subsequent measurements. So at the end of each year, how are we going to measure this particular item? You have already learned under PP&E that you may use either a revaluation model or a cost model for your subsequent measurement year on year. These are the types of considerations you would want to take into account when looking at measurements. If the definition and the recognition criteria are met, then the element needs to be recorded via a journal entry. You must recognize, measure, and record. Measurement is equal to calculating the amount to use in the journal entry, and it requires significant judgment. The method again is going to be dependent on the applicable standard. As with our example in property, plant, and equipment, you may choose between the revaluation or the cost model. With each standard, there are various options, and you would need to apply that to your subsequent measurement. The various methods of measurement really depend on the type of item that you are dealing with. So historical cost is typically what you would bring an item into your financial statements at in terms of initial measurement. The minimum economic benefits it expects to cover, or the maximum economic benefits it expects to settle. The first is for an asset and the second is for a liability. So it is important that we always act on a more prudent side of reporting. So for assets, we would rather go for a minimum, and with our liabilities, rather go for the maximum. So be more prudent when determining your measurement amounts. Your current value is further split up into 3 items: fair value, value in use, and current cost. Fair value you will come across under a number of different accounting standards, and you will always be given this figure for second year. It is not something that you would be required to work out or calculate. The fair value is simply defined as the price that would be received to sell an asset or paid to settle a liability in an orderly transaction between market participants at the measurement date. So it is the current value or the current price for any particular item, either an asset or a liability. Typically, you will find fair value discussions being brought through in our asset section, which is our main focus for semester 1. Value in use. Our value in use concept is defined as the present value of cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its disposal. The value in use figure, again, is a figure that you are not required to calculate in second year accounting. You would be given it in a test or exam. However, you will need to know which figure is the correct value in use for that particular scenario. The current cost. This is the cost of an equivalent asset at the measurement date, comprising the consideration that would be paid at the measurement date plus transaction costs that would be incurred at that date. Okay, this is also an important cost that would be used often for your initial measurement when bringing an asset into your set of books for the very first time. Considerations for measurement basis selection. So the measurement basis selected must provide information that is relevant and a faithful representation of the substance of the transaction. Now, our old conceptual framework often referred to this principle of always looking at the substance over the legal form. This may mean that legally you may have X, Y, and Z, but in substance of the transaction, that is what we would want to include in our financial statements. You will see this coming through in a topic shortly. When you look at your financial instruments, we account for your shares looking at the substance of the transaction. So if you have shares that are compulsory redeemable, meaning you have to pay them back and redeem them in 3 years' time, in substance, that is seen as a liability because in fact you need to pay them within 3 years' time. Whereas legally, it may seem that a purchase of shares is in fact equity for the business itself. Other considerations are enhancing characteristics of comparability, verifiability, and timeliness. You certainly don't want to chop and change between policies, and this would make comparability difficult for your current year and your prior year figures. The last chapter that we cover in Accounting 2 is presentation and disclosure. If the definition and the recognition criteria are met, then you must recognize and disclose in the financial statements if required or material. Okay, so generally, once your definition and your recognition criteria are met, you then follow the process of recognizing through journals and then disclosing in your financial statements where appropriate. If the definition and recognition criteria are not met, then you do not recognize these in your financial statements. However, you can disclose the information in the notes as a narrative if it is deemed to be relevant. So if it is going to aid that overarching objective of usefulness in the financial statements, then you would want to ensure that is included as a narrative in the financials. Okay, the last chapter is chapter 8, which is our concepts of capital and capital maintenance. This is in fact not included within your scope for Accounting 212. So in conclusion, your conceptual framework is a vital piece of information that is a framework that outlines all of your accounting standards upon which they are based. This conceptual framework is something that is going to flow through all of your accounting standards that are to follow for the rest of the year.